we believe investors will become more concerned about a declining growth dynamic in terms of the US economy. Consequently, we're neutral in terms of our equity positioning. Welcome to our key points for December. Now this month, our take on the plunge in inflation, is this likely to be continued? We look at the bond markets and the fact that investors are now pricing in a policy pivot by the central banks. And we come back to the equity markets and ask the question, are we at an inflection point for higher returns ahead? Now, turning to our first point, recent data coming out of most parts of the world show that inflation continues to decline at quite a fast pace. If I look at the chart that I'm showing you here, you can see the blue line is US inflation. We've shown this before, has come down quite consistently over recent months. And of course, we've now seen the Eurozone see inflation also fall at a pretty rapid pace. Not just the headline, but you can see also the core levels are coming down as well. Now, a lot of this is still coming from the goods and trade sector. The services are still a little bit stickier, but broadly speaking, we think that decline is going to continue, although to be fair, it will be at a slower pace. We're still a little bit away, of course, from the central bank 2% targets, but I think the recent data prints must give them some cause for optimism, and that's certainly also been true for the financial markets, which have been, again, cheered by this further decline in inflation. So turning to our second point, how have financial markets interpreted these declining inflation readings? Well, the answer is very well. If we think about the bond market, once again, they're now pricing in a policy pivot by the central banks. They're looking at these better inflation readings and thinking the banks will no longer have to be increasing rates, but actually be cutting rates as we get into perhaps to the middle of next year. Now, we've been here before, you might remember, over the course of this year, only to be disappointed. But I think that we're now seeing tangible improvements in inflation is encouraging investors. And indeed, that's what we can see in the chart I'm showing you here. Both Bund, German 10-year yields and 10-year Treasury yields have been moving or had been moving up over the summer months. There was concern about policy being higher for longer. There was also concerns about fiscal issues, particularly in the United States. But that's now changed. A combination of the better inflation prints that we've seen and some bond issuance coming through in the US has alleviated some of these pressures. In other words, we've seen a peak, we believe, in terms of interest rates. And now we're seeing bond yields fall. Where do they go from here? Well, given what I said about inflation, we think they can fall further, particularly as we think growth will be under pressure in the first half of the coming year. But they're not going to go so far further. We don't think we're going to go back to the lows that we've seen in the last few years. But from here, we think there are further declines in yields ahead. So turning to our third point, what does this mean for equity markets? Well, investors have embraced the decline in inflation and the decline in bond yields. And that's led to a bounce in equities over the last month. If you look at the chart I'm showing you, you can very evidently see that. But it's worth remembering the S&P 500 in the US, what I'm showing you here, is still below the levels it was at 2 years ago. And in that intervening period, we saw the precipitous declines in 2022, a recovery in the first part of this year, then concerns about interest rates being higher for longer, before finally investors are now embracing the concept that a policy pivot is likely in 2024. Now, if I drill into that same chart, you can see very evidently the downtrack we spoke about last month. We thought there would be a bounce, and indeed that happened, but that bounce carried on and it broke that downtrack. In other words, the lower highs that were in place have been taken out, and now the market is very close to the summer highs. Where do markets go from here? We suspect it becomes more challenging. Yes, there's been a broad rally, as we've seen recently, but the year-end effects are likely to wear off. And as we get into the beginning of next year, we believe investors will become more concerned about a declining growth dynamic in terms of the US economy. Consequently, we're neutral in terms of our equity positioning. Now remember, as always, you can read the full report on Zurich.com. And I would like to wish you all very happy holidays and a prosperous new year.